Hi, today we're going to have a look at the 2013 Leaving Cert Higher Level Production Cash Budget. The first thing we were asked in the production cash budget is to prepare a production budget for 4 months, January to April 2014. So to do that, we're going to set up like this. For the production cash budget, with the production budget for part A, we start off with sales. Then we add closing stock because whatever we want to have at the end of the month in closing stock, we have to make those also. And we take away opening stock because any stock coming forward from the previous month, we won't have to make again. So we've already done this. If you have already covered the production budget question on its own, you have already done this format where you start off with sales, then you add closing stock, you have to make those, and you take away opening stock because if they're made in the previous month, you won't have to make them again. And that will give you what you need to sell because you won't always need to make the same amount as you need to sell because there's opening and closing stock. Again, we're just asked to do this from January to April, but we need a column for May because down here further in part B, a figure is a certain percentage of the May figure, so we need that extra column for May. And we actually also need the sales figure for June to get this closing stock from May. That's why in the question, they have given us 6 months, even though we're only asked to do 4 months. So to start off anyway, we are just going to take the sales figures from the question, so the units. And again, we're working in units here in part A, not materials, in units. So I can see January sales were 7,000 units, February 8,000, March 10,000, April 9,000, May 10,500, and we don't need a column for June, but I will put in the June figure, which was 11,000. Now, in the question, it says stock of finished goods, and that's what we're talking about here, units, are maintained at 70% of the following month's sales requirements. Now, it's the following month's sales requirements. So that means, again, just look at it, finished stock of finished goods are 70%, which means my closing stock is 70% of the following month's sales. So this figure here is 8,000 by 70%. February, 10,000 by 70%. March, 9,000 multiplied by 70%. April is 10,500 by 70%. And May is 11,000 by 70%. And that's why we need the sales units for June. Now, the next thing then, we are just going to add those because in January we want to sell 7,000, but if we want to have 5,600 extra left over at the end, then we're going to have to make 12,600. And that's going to be the same for each of the rest of the months. In January, there's going to be no opening stock because the top of the question says the business was only set up on the 1st of the 1st. So it's only set up on the 1st of January, so there won't be any opening stock coming forward from the previous December, so that's going to be 0. My opening stock in February is simply my closing stock in January. Opening stock in March, closing stock in February. My opening stock in April is simply my closing stock in March. My opening stock in May is my closing stock in April. And again, we're just going to take the opening stock away, so 12,600 minus 0 is 12,600. And again, I'm going to do the same the whole way across. So in January, just have a look at a couple of the months. In January, we want to make 7,000 units, sell 7,000 units. We want to have 5,600 left over at the end, so I'm going to need to make 12,600. I have none coming forward, so I need to make 12,600. In February, for example, I want to sell 8,000 units, and I want to have 7,000 left over at the end, so then I need to make 15,000. However, I have 5,600 coming forward from the previous month, so in February, I only need to make 9,400 units. Part B of the question then asks us to prepare a raw materials purchases budget in units, which is in kgs, and in euros for the 4 months, January to April. So again, I'm going to have to start off with 5 months, as you'll see why in a minute. So first thing here again, the units required for production, I'm simply getting those from part A. So these are the units we need to make in part A. Then in the question, it says that to make a unit, we need 5 kgs of this material X. There's only one material needed to make these units, material X, and we need 5 kgs per unit. So I'm simply going to multiply all the units by 5. And that's going to be the same the whole way across. Now, the closing stock of materials we can see in part III. So stock of materials sufficient to 20% of the following month's requirements in kgs are held at the end of each month. So closing stock is 20% of the following month's requirements. So again, closing stock here is going to be 20% of the 47,000. February is 20% of the 46,500. April, 20% of 5250. So March, and then in April it's going to be 20% of 54,250. And that's why we needed to work down this far for May, because I needed to get 20% of that figure. And now we've worked on that far, you can forget about May. So just a double line underneath that, we can forget about May. So again here, the required for production, I'm adding closing stock, so just simply adding those down. And for the same reason as in part A, again, there is no opening stock coming forward from December, so that's going to be 0. And my opening stock in February is simply my closing stock in January. And that's going to be the same the whole way across. So required for purchases then is going to be, I'm going to get my 72,400 less the opening stock, which is 72,400. And again, I'm just going to simply take away the opening stock the whole way across. So that's what I need to purchase in kgs of this material X each month. Now, what is the price per kg? In the question it says the price per kg is €2. So for every kg it's going to cost €2. So I'm simply just going to multiply all of these by 2. And that will give me the cost in euros of the purchases for the 4 months. And I'm going to add those up because I'm going to need that later on in the question. And they come to 435,200. So that's the kind of production budget part of it done. And then the next part C, we are asked to prepare a cash budget for the 4 months. And again, it's only for the 4 months, not for the 6 months. So the cash budget, and again, this is very similar to just the cash budget question on its own, maybe slightly easier. So to start off, in the question, it says that if we look back up here to part IV, the cash collection pattern for sales is expected to be, so 40% of people pay by cash to pay straight away, and then 60% pay on credit. That makes up the total amount of customers. Of the 60% that pay on credit, it says 50% pay the month after sale, and the remainder in the second month after sale. So in January, for example, we're going to get the cash in January, then we're going to get some money 1 month later in February, some money 2 months later in March. There'll be nothing here in credit sales 1 month and 2 months in January, because 1 month before that would be December and the company wasn't set up. 2 months before would have been November and the company wasn't set up. In February, we are not owed any money from 2 months before, as that would have been December and the company wasn't set up, but we are owed money from 1 month before, which is January. So we just need to start filling this in now. So again, with January, I'm going to start off with the January sales. So sales in January were 210,000, and of those, 40% were for cash. So this is going to be 210,000 by 40%, which is 84,000. And then 60% was on credit. Okay, so again, I'm starting off at my 210,000 by 60%, because 60% were on credit. And of the ones on credit, I received half of that in 1 month, so I multiply it by 50%. And the other half, it's going to be the same figure, I received in March, which is also 63,000. In February, my sales figure in February was 240,000. So it's going to be the exact same thing here, only I'm going to use 240 instead of 210. So 240,000 by 60%, and here 240,000 by 40%, sorry, 60% were on credit, by 50%, which is 72. And again, that is going to be the same figure here. I just had to double check. I multiplied February. This is incorrect. This should have been 40%. So you just need to be careful when you're filling these in. Just go back to the question. So again, March, I'm going to get March sales, which is 300,000. So again, this is going to be 300,000, and by 40%, it's 40% worth of credit, sorry, for cash. And then this is going to be, and again, I'm just going to double check my March is 300,000. So this is 300,000 by 60% were on credit, by 50% of those received a month later. And I obviously don't have to do May. Then April is going to be 270,000 out of sales. So it's 270,000 by 40% were for cash. So now I'm simply just going to add these across and total them down. So that comes to 768,000 as total receipts. And again, this is a budget you're looking forward. That's what we plan to have received in cash in the first 4 months. Payments then. This is slightly different than the way it's asked in the just cash budget question on its own. And in that question, you would have had purchases 1 month and 2 months. Here it simply says that 1 month's credit is received from suppliers. So meaning what you purchase, you pay for a month later. So my purchases, and again, in January, I'm not going to pay for any purchases because there are no purchases 1 month earlier in December. In February, I'm going to simply pay for January's purchases from Part B. In March, I'm going to pay for February's purchases. And in April, I am going to pay for March's purchases. And it's going to total those across. Wages. In the question, it says that wages are 25,000 per month payable as incurred, just meaning that it's paid in the month the expense is. So that's just simply 25,000 each month. Variable overhead is €5 per unit payable as incurred. We need to be very careful here when we're doing this. We just get the units and we multiply them by 5, but you just need to be careful which units. You're going multiplying the units produced from Part A by 5, not the sales units. So we're going to go back up to Part A, and I'm going to multiply the 12,600 by 5. The next month, 9,400 by 5, and so on, not the sales units, because the cost is associated with the units that we actually produce. So that's going to be 63,000, and again, I'm just going to multiply all of those by 5 from Part A and add them up. The next thing are fixed overheads. So again, it says fixed overheads, including depreciation in brackets, is 30,000. Now, the reason including depreciation is in brackets is because we need to take out depreciation, and I should set the alarm bells ringing when you see it in brackets. Depreciation is a non-cash item. You don't physically pay over depreciation to anybody, so it shouldn't be included in the cash budget. It will, however, be included in the profit and loss account, but it doesn't go into the cash budget here. So I need to work out the depreciation and then take it away from the fixed overhead. What do we depreciate? We depreciate assets. What asset do we get? You can see here we bought equipment for 45,000, and that has a useful life of 5 years. We're doing the cash budget on a monthly basis, so 5 years equates to 60 months. So to work out my depreciation, it'll be just 45,000 divided by 60. So I can just do that to the side over here. 45,000 divided by 60 is 750, and you'll actually need that figure later on when you go through a profit and loss account. So just write it down somewhere and show your working, just so you'll have it for later on. So now the fixed overhead, instead of being 30,000, it's going to be 30,000 minus 750, which is 29,250. That's going to be the same each month because it's fixed. And again, I'm just going to total those. Equipment, very straightforward. Equipment was purchased in January for 45,000, so it goes in here. Again, equipment would not go into the profit and loss account because it's not an expense, it's a fixed asset, but we did pay 45,000 for it, so it has to go in the cash budget. We're going to total these across. They come to 45, obviously. And then the loan interest. So again, when you did the cash budget on its own, sometimes you had a loan installment and loan interest. If you started paying back the loan straight away, then you had a loan installment, and then if the interest was calculated based on the amount of loan outstanding, the interest went down. Here, that's not the case. It says that we got a loan of 30,000 and that was secured at 10% per annum. That's the interest rate. The interest is paid monthly, but the capital loan repayments will not start until July. We're only doing it from January to April, so there's no loan installment. And the interest is very straightforward then, because it's going to be the same each month, and it's just 30,000 by 10%, but that will be per annum. So we just divide that by 12 or multiply it by 1 over 12 to get it on a monthly basis. So I'll just be working here, 30,000 by 10%. That's per annum, and then multiply it by 1 over 12 to get it on a monthly basis, which is €250. So that's just going to be €250 each month. That totals 1,000. So now I'm just going to add my payments down. 162,500 is the first month, add them all, and in total they come to 802,850. Now I have to work out my net monthly cash flow. So this is basically just to see will we be up or down each month. So you can see here in January I'm getting in 84,000, paying out 162, so I'm going to be down. So I'm simply just each month I'm getting my receipts and taking away my payments. And I'm going to do that the whole way across. So you can see here in January and February we plan to be down money, but then in March and April we will be up. And in total over the 4 months we plan to be down 34 grand. A bank loan then is going to go in here, because if we get a bank loan, you might think a bank loan would be going as a negative figure because I suppose it's bad, you have to pay it back. But for the sake of a cash budget, it's 30,000 more that we have to spend. So it's going to go in as a plus 30,000. And that was got in January, and we didn't get any more loans. So that's simply going to total 30,000. Opening balance is 0 because the company was only set up in January, so there's no cash balances coming forward. And whatever goes in the first column here is going to go in the total column, so that'll also be 0. And now we simply add these down. We plan to be down 78,500 for the month, but we're going to get a loan of 30, so we're really going to be down 48,500. My closing cash in January will be my opening cash in February. Again, I'm going to add these down. My opening balance in March with my closing balance in February. Again, add these down. Opening balance in April, my closing balance in March, and add these down. Now, this 48,500 does not go here because it's not the next month, it's the total column, and there's already a 0 figure in there. Again, I'm going to add this total column down, comes to minus 4850, and these two figures here balanced, they should always be the same. So for the 4 months, after including the loan, we plan to be down 4,850. Part D then is a budgeted profit and loss account. So for Part D, it's a budgeted profit and loss account, and it tells us the cost of a unit of finished goods is €25. Again, we just need to be careful. This is only for 4 months we're asked to do this. So for the sales, I'm going to add up my sales, but from the question, but again, it'd be an easy mistake just to add them all across. It's only the first 4 months. So 210, 240, 300, and 270. 210, 240, 300, and 270. So that comes to 1,020,000. Then we have to take away the cost of sales. Opening stock will be 0 because the company was only set up, there's no stock coming forward. My purchases figure I am going to get from Part B. I'm not going to take this purchases figure from the payments. Why? Because that's what we physically paid. not what we actually purchased, because it was 1 month, we got 1 month's credit. So what goes into income and expenditure account or P&L account is what you actually sold or what you actually purchased, and the purchases for the 4 months is going to be 435,200. Then I'm going to need to take away my closing stock. But we have two different types of stock. We have stock of finished goods from part A and stock of raw materials from part B. So if we go back up and just see where these green and blue figures are coming from, and again, we just need to be careful. This profit and loss account is at the end of April. So if I go April and then across from closing stock, I had 7,350 units at the end of April. That's where that figure is coming from. And then the materials, again, April, and across from closing stock here, I had 10,850 kgs. That's where the 7350 and the 10850 are coming from. The 25 is actually from part D of the question. We read it there a couple of minutes ago. It tells us in the question that the unit cost of a finished good is 25 euros. So that's where 25 euros is coming from. And the €2 again is on the top of the question. It says materials are worth 2 euros. That's why we multiply the kgs by 2. So this is going to be 7350 by 25 and 10850 by 2. So in total, closing stock comes to 205,450, and sorry, I should have added. So here, opening stock plus purchases comes to 435,250, and then I'm going to take away my closing stock, which will leave me with a cost of sales of 229,750, and then sales less cost of sales gives me gross profit, 790,250. Now I have to take away my expenses. So wages, variable overhead, and fixed overhead are all coming from the cash budget because they were all payable as incurred. So wages is going to be 100,000. Variable overhead 206,750, and fixed overhead 117,000. As I said before, equipment will not go here because it's not an expense, it's a fixed asset. And depreciation we worked out already in the cash budget. Remember, we had to take it away from the fixed overhead on 750 a month. That doesn't go in a cash budget because it's a non-cash item, but it is an expense. So it's going to be 750 by 4 because we're only doing 4 months. So again, if I total these down, that comes to 426,750, and my gross profit less my expenses give me an operating profit of 363,500. The last thing I need to do now before I get my net profit is just take away the interest, which again is simply coming from the cash budget. It's 1,000. And that leaves me with a net profit of 362,500. The last thing then is just a small bit of theory. What useful information is available to Murray Limited from the completed cash budget, and what is meant by a capital budget? So from the cash budget, they will be able to see which months there is a deficit of cash, and which will enable them to make arrangements for loan or overdraft, as we've seen in January in the question. They will see which months will have a surplus of cash and will be able to arrange short-term investments. Maybe if they have extra cash, they might invest somewhere else. We can see here there's a surplus of cash in March and April. The trend of cash shortages is getting smaller, which is normal for a new business, and overdraft facilities will be required each month up to a maximum of 135,800 in any month, and the closing cash shortage is 4,850 at the end of the 4 months. A capital budget deals with planned capital expenditure, for example, the purchase of a fixed asset and planned capital receipts, for example, the sale of fixed assets, so they're not current, they're capital, they're bigger items. Decisions regarding capital items are the responsibility of board of directors, and carrying out the capital budget is the responsibility of the financial controller. So that's the question finished. If you want to have a look at some of the other videos, and if you like, you can subscribe to the YouTube channel. Thank you.